Let's have a real conversation about the American and European dream. For decades, we've been fed a very specific script. Go to school, get a job, get married, and buy a house. In that world, a mortgage wasn't just a loan. It was a badge of honor. It was the ultimate proof that you had finally made it. But it's 2026. The economic landscape has shifted beneath our feet. Housing prices in cities like Toronto, London, and Austin have reached levels that would make our parents' heads spin. Today, we're going to dismantle the emotional baggage attached to homeownership and look at the cold, hard math. We're going to treat your life like a balance sheet. Is a house an asset, or is it a liability disguised as a trophy? To understand 2026, we first have to understand the psychology of the white picket fence. Most of us were raised by a generation that saw massive property appreciation. For them, buying was a no-brainer. But they lived in a world of high supply and lower mobility. In 2026, the social pressure to buy is still there. We see it at family dinners and on social media. We finally closed with a picture of a shiny set of keys. It's seen as a social achievement, a mark of stability. But here is the professional truth. Stability and wealth are not always the same thing. Buying a home because you feel behind in life is a catastrophic financial strategy. Real wealth doesn't care about your social status. It only cares about your internal rate of return. Let's look at the buy side of the ledger. The primary advantage of buying is forced savings. Every month you pay your mortgage. You are essentially moving money from your left pocket to your right pocket in the form of equity. In the USA, the tax advantages, like mortgage interest deductions, are still a massive play. Then there's the psychological hedge. When you own, your rent is locked in. While the neighbor's rent goes up 5% every year, your 30-year fixed mortgage stays the same. In an inflationary environment like 2026, that is a powerful shield. You are essentially shorting the dollar to own a hard asset. However, the disadvantages are often hidden in the fine print. Maintenance, property taxes, and insurance. In 2026, climate-related insurance premiums in places like Florida or parts of Europe have tripled. You aren't just paying the bank, you're paying the unseen trio of taxes, repairs, and protection. Now, let's talk about the rent and invest model. This is where the master's degree level math comes in. Renting is not throwing money away. That is a 1980s myth. Renting is simply paying for a service, which is shelter. The biggest advantage of renting in 2026 is agility. In a global economy, your greatest asset is your ability to move where the capital is. If a job in Zurich or Silicon Valley offers you a 40% raise, the renter can leave in 30 days. The strategy here is opportunity cost. If you take the $100,000 you would have used for a down payment and put it into a diversified index fund, and then you invest that savings gap, the difference between a mortgage payment and your rent, the math often favors the renter over a 15-year horizon. You are trading that forced savings of a house for the voluntary growth of the market. So, when does it actually make sense to buy? Number 1, if you plan to stay put for at least 7 to 10 years. The friction costs of buying and selling will eat your profits if you move sooner. Number 2, if you are in a market where the price-to-rent ratio is low. If it's cheaper to own than to rent a similar square footage, the math dictates the move. And when is it better to rent? If you are in a hyper-growth phase of your career. If you need your capital to start a business, or if you value the freedom to pivot. In 2026, being liquid is a superpower. Don't trade your potential for a basement that might flood. The final reflection for today is this. Success in 2026 isn't about the title on your deed. It's about the freedom in your calendar. If buying a home makes you house poor, meaning all your money goes into the walls around you and you can't afford to travel or take risks, then you haven't bought a dream. You've bought a cage. Analyze your local market. Run the numbers without the emotion. Stop trying to impress your parents and start trying to fund your future self. Wealth is what you don't see. It's the brokerage account, the private equity, and the peace of mind. Whether you sign a lease or a mortgage tomorrow, make sure you're doing it for the math, not the ego. I'm not a financial advisor, I'm just someone who looks at the spreadsheet so you don't have to. Stay smart. Stay mobile. And I'll see you in the next one.